Investing in the stock market can be a daunting task for even the most experienced investors. With the constant fluctuations and volatility of the market, it can be difficult to predict the future direction of the market. This is where options trading comes into play. Options provide investors with the ability to proactively hedge their portfolios against potential market crashes. In this video, we will discuss the importance of being proactively hedged in an options portfolio. One of the most critical reasons why it is important to be proactively hedged in an options portfolio is that it's too late to hedge once a market crash has already started. When a market crash occurs, the price of stocks plummet and investors suffer significant losses. The time to hedge your portfolio is before the crash occurs, not after. Proactively hedging involves taking steps to protect your portfolio before the market downturn occurs. Proactively hedging involves purchasing options that will benefit from a market downturn. And these options are typically put options, which give the holder the right to sell an underlying asset at a predetermined price. When the market crashes, the value of these put options increases, offsetting the losses incurred in the underlying stock. Another reason why it is important to be proactively hedged in an options portfolio is that it can help reduce the overall risk of the portfolio. By purchasing options, investors are essentially buying insurance against potential market downturns. While the cost of these options can be significant, they can provide a significant return on investment if a market crash occurs. In essence, proactively hedging is a form of risk management that can help protect investors from significant losses. Furthermore, proactive hedging can also help investors take advantage of market opportunities. When the market is in a downturn, there are often opportunities to purchase stock at a discounted price. And by hedging their portfolios, investors can protect themselves against losses while still having the capital available to take advantage of these opportunities. Now, there is a well-known technique used to proactively hedge while looking to profit, and this technique is called a collar strategy. This strategy involves simultaneously purchasing a put option to protect against the downside risk while selling a call option to generate income or finance the position. The income generated from selling the call can be used to finance the purchase of the put, effectively creating a collar around a portfolio. A collar is a strategy that is commonly used to limit the potential loss of an underlying asset while also capping its potential profit. It is created by combining a long position in an asset with a protective put and a short call option. While a collar can be an effective way to protect an investor's position in the market, there are several weaknesses to this trade structure, and here are a few examples. Number one, limited profit potential. One of the main weaknesses of the collar is it limits the potential profit that an investor can make. And by using a protective put and a short call option, the investor is essentially giving up some of their potential gains in exchange for protection against losses. Now, while this may be a smart move in certain market conditions, it can also be a hindrance in others. Number two, cost to implement. Another weakness in a collar is it can be expensive to implement, and this is because the investor must pay for the protective put. And depending on the price of the underlying asset and the specific options being used, this cost can add up quickly. Number three, it requires active management. A collar can also require active management in order to be effective. This means that the investor must be constantly monitoring the market and their positions in order to make informed decisions about when to adjust the collar. And this can be time-consuming and stressful for some investors. Now, the collar strategy, while well known, has some weaknesses that can limit an investor's potential gains and requires active management. However, there are lesser known strategies that can achieve the goal of proactively hedging without these downsides. And these advanced techniques involve combining ratio spreads with butterflies and relying on second order Greeks. And as a result, these strategies offer several advantages, including, number one, greater flexibility. These advanced strategies are more flexible than the collar strategy, allowing for more nuanced adjustments to an investor's position in response to changing market conditions. Number 2, lower costs. These strategies are less expensive to implement than the collar strategy, which requires the purchase of a protective put that could be closer to the money. Number 3, potential higher gains. By relying on second-order Greeks and combining ratio spreads with butterflies, these strategies have the potential for higher gains than the collar strategy. And number 4, they reduce the need for active management. These advanced strategies can require less active management than the collar strategy, which can be a benefit for busy investors who prefer a more hands-off approach. While the collar strategy has its place in certain market conditions, there are advanced options trading strategies that can offer several advantages over the collar strategy. These techniques are worth exploring for investors who are interested in proactively hedging their positions while also maximizing their potential gains. In conclusion, investing in the stock market can be risky and unpredictable, but options trading can provide a way to proactively hedge against potential market crashes. Being proactively hedged involves taking steps to protect your portfolio before a market downturn occurs. The collar strategy is a well-known technique used for proactively hedging, but it has some weaknesses that can limit an investor's potential gains and require active management. However, there are several advanced options trading strategies that can offer greater flexibility, lower cost, and the potential for higher gains while reducing the need for active management. Ultimately, investors should consider all options trading strategies to find the one that best suits their risk tolerance, investment goals, and market conditions. By proactively hedging their portfolios, investors can reduce their risk of exposure, take advantage of market opportunities, and potentially achieve higher returns. If you're a trader looking for trading consistency, if you keep changing your approach, looking to add one more rule that will get you over the top, I'm going to help you for free. Stay with me for the next minute or so. Now, who am I to make this claim? My name is Karl Domm, Karl with a K, and it took me over 20 years to finally succeed to become a profitable options trader. And I have publicly proven to be a profitable trader since I started sharing my P&L on my YouTube channel in May of 2019. Now, my larger options trading account started with $110,000 and now is worth over $165,000. And I'm the only YouTube instructor that shares my daily P&L, proving that I am a profitable options trader. Now, I've asked many other instructors to share their P&L, but they don't because they can't, because they actually lose money trading. And I'm frustrated with the lies being told. If you've ever taken an online trading course, I'm 99% sure that you're frustrated and that you've lost money following these instructors. And you already know that they don't share their P&L. Now, as far as trading myself, I just happen to have a passion for options trading. And I spent over 27 years learning and trading. And I'm not necessarily interested in the technical aspects of options from a scholastic point of view. I've been passionate about the most efficient way options can make me money. And this is my calling in life, as corny as that sounds. And I've even written a book on the subject, even though I hate writing. For some reason, trading ideas just flow into my head all the time, and I take those ideas and I spend hours and hours backtesting them. And after backtesting over 300 ideas, one of the trades I developed was a trade that I call the 2060. This is a proprietary trade I developed almost from scratch. I initially created the course to sell it, and I wanted to compete with these other YouTubers that were frustrating me with their fake claims. But what I've decided is I want to do what it takes to expose those YouTube fake gurus. And if I can offer something for free that is vastly superior to their paid products, maybe I could put a dent in their business, which in effect would be using my talents to help people. Because of this, I'm currently providing the 2060 course at no cost. And this is a full course. It's not a worthless free report or some piece of useless, non-actionable information. This is a full course with black and white rules that you can use to take action and learn how profitable options traders trade. This course is worth $495, but I'm giving it away today for free. See the link in the description to sign up for the course.